people will always figure out things that could be better. And as long as that attitude exists for most people, there will be companies on the other side trying to figure this stuff out.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right, welcome to this episode of The Bull of Wall Street. My name's Talley Leger. I'm the Chief Market Strategist of the Wealth Consulting Group, and I'm joined by my boss and founder of WCG, Jimmy Lee, and we are delighted to host this episode with our very special guest, Sam Rowe, the award-winning newsletter writer and founder of TKer. Sam, welcome to the show.
Thanks for having me. I'm excited to be here.
100%. So I got to tell a little story here of how we met. I think it was the end of last year. It was at a dinner in Manhattan at Sparks with our mutual friend, Ryan Dietrich. Man, we know a lot of the same people. We run in the same circles. And I don't know about you, but Ryan has this uncanny ability to kind of send the bat signal and we all converge at the same location.
Yeah, it's funny. I think part of it definitely helps that we've been around for a little while and we know what that bat signal looks like, because every once in a while you send that out and you realize someone's left the industry, or they've changed jobs or moved out of the wherever. But yeah, he's pretty great about doing that. He's both a great friend, both professionally as well as socially.
Absolutely. Well, we've had him. This is really because of Jimmy on this pod a couple of times, and we thought, hey, let's get Sam on. And it was at that pregame where I picked up some poker chips. I brought stage props. This is the TKer poker chip. And we also have the Wealth Consulting Group poker chip. Look at that.
Oh, sweet.
Vegas based, baby.
Yeah, wow. You'll have to toss me one of those the next time I see you.
Will do.
They don't work in the casinos, though, Sam.
No, they will do the exact opposite of working in a casino. The last thing you want to do is put something on a table that's not the house's chips.
That's true. 86.
Well, before we get in, I mean, that's such a great metaphor for markets, but maybe we should talk a little bit about the general stuff first. Like, I look at your background, Sam, and there's so much we can talk about. Like I'm a fan of the old Axios Smart Brevity framework. I use that for our kind of rapid responses. I've done that recently. I know you were there. Yahoo Finance. I mean, we're on there all the time. And Jimmy was just telling me before we hopped on how he's a fan of your content. But Jimmy, why don't you kind of jump in here and talk about some of your shared DNA?
Yeah, well, that's funny. First of all, we were just chatting in the kind of talk that we had before the recording that I had to look up on ChatGPT. Now, of course, I knew who Sam was or is through listening to a podcast with him on various shows like the Compound and Friends. I think he's the most returning guest, or the guest that comes back the most.
I think that's right.
But and then through Ryan said, you guys get Sam on the show. He's like so good. And so, but then researching him, I'm like, Rowe, R-O. I don't know any Koreans named Rowe, but I bet you he's Korean. So I looked him up on ChatGPT, and it says he's Korean American. In the pre-show, he said he's Korean American. Were you born in the United States or in Korea?
I was born in the United States. So my parents moved over from Korea in 77 and 78. My dad came first and then my mom followed. And I have two older sisters who were, I guess they were 2 and 5 when they came over. But yeah, in Korean, the last name is No, which isn't exactly a popular Korean name either. So it's like, if you go even further back, if you go a little bit further back, and we don't talk too much about this. I mean, this is also a Korean thing, but like if you go a little bit further back, the Chinese origin is Lo, and then we had ancestors from my father's side who, God knows when they came to Korea, and then it became No, and then when they moved over to the U.S., it became Ro.
Wow, I like it. So Lo, and we said No, and then No in the United States to Ro. Okay.
Yeah.
But
the Korean community here still calls him No. The Korean, the way he writes, we all write our last name is still No, which is funny because my father has he has a PhD, and the folks in the Korean community, when they speak to him in English, sometimes refer to him as Dr. No.
I love it.
That's what I was going to say. It's old James Bond fame. I love it. Well, our family immigrated about the same time in '77 to the United States and to Las Vegas. So we can talk about that later. I'm sure everybody's like, what are these two Korean guys talking about? But we probably both like Korean barbecue. So I can't wait to come back to Manhattan. And I've found some newer barbecues. I'm sure you know of them. But there's one called Hoo near Koreatown that I really like. But anyway,
let's make it happen.
Yeah, Talley, I don't know about shared DNA, but we've got similar background. And
Sure.
but I started out as a financial advisor, Sam, and so the way that you write, and I know a lot of your clients, in particular, are financial advisors. I think it's so relevant for us, and I have an opportunity, and I've had an opportunity to work with financial advisors my whole career almost. And there's still a lot of us that, think we're the Warren Buffetts, and Warren Buffett doesn't even market time, but we think we can market time. So I love the fact that you really promote, 10 things, fundamentals about why we should be thinking about as long-term investors, stocks for the long run, to steal a line from Jeremy Siegel. But I like that you have all this data behind it, and the charts to back that stuff up. And as you say, right, 365 days out, the market's up, 75% of the time. So if you're going to be market timing or you're a short investor, it's not that easy because you got a 25% to be right over a 1 year time frame. And listening to your podcast, you were saying that on a daily basis, it's like 50-50. So maybe my first question to you is, tell us a little bit about why you believe what you believe in your philosophy. Is it, I know from doing, writing all these years and your research, tell us about that. And coincidentally, Bob Pisani we interviewed, who's also obviously in the same industry in the past, he has that similar bias too. And it's probably because he's seen so many people doing something else and they just lost money. But go ahead.
Yeah, I mean, well, the short answer is actually pretty straightforward and helped me become an independent writer and gave me the confidence to go independent. The short answer is over the years, writing at big financial news sites for 15 or, I mean, if you go into ancient history, I worked at Forbes even briefly before the financial crisis. But a piece of feedback that I often got, I didn't get a lot of it, but it was enough that I noticed that there was an opportunity. Some feedback that I would get would be from readers who would read about charts or data or stats that I would share that sort of would feel contrarian especially during times of market volatility or downturns or pullbacks. And it was this realization that, there's this feeling, people had a feeling that there was something insufficient about the financial news, the daily financial news, whether it's CNBC or Bloomberg or, where I worked at Yahoo Finance and Business Insider and even Axios, frankly. There was a dissatisfaction with the news experience because, they felt like it was not giving them the right framing of the market narrative, because they would constantly feel this sort of sense of consternation because of what they were getting. I'll get into a little bit more detail with this. They didn't feel great about it, but then they look at, their annual statements or their quarterly statements even, or, if you've been investing or saving for a couple of years, you see the market progression over 1, 5, maybe 10 or even 15 years. And then you see the stock market going up. And it's like, what the heck is going on here? Like, how is it that, and sometimes we hear that it's because we're climbing the wall of worry and all these different euphemisms about how you got to be contrarian all the time. Something that I came to realize, and Jimmy, this speaks to something I mentioned on an earlier podcast, is there's actually a very straightforward stat for this, and it's that on a one-day basis, historically, there's about a 50-50 chance that the market's going to either be up or down. Which means if you are a daily consumer of financial markets information, you're probably going to be somewhat slanted in sort of like half bullish news and half bearish news, just because of how that works. When, as you guys know, over those extended periods, the percentage is actually much higher. So my thinking with the newsletter is, I'm going to still write about all the same market developments and the movements in, the economic data and monetary policy and geopolitics and everything. But instead of trying to, tie that back to what the market did today or this week, I try to put this into the greater, a larger time frame. I'm going to tell this story in terms of this is happening right now in the context of the past 5 years or 10 years or if we want to do the historical analogs, this is what happens over rolling 10-year periods going back 200 years. And what you inevitably get is you'll also find yourself in places in history where all kinds of bad things were happening, including oil spikes and, flare-ups in the Middle East and, questions and doubts about monetary policy and political upheaval and all these things. It's not about sort of downplaying it. By no means is this about downplaying anything that's going on in the current moment, or even ruling out that maybe things could be different this time. But it's just all about adding a little bit more context and framing these stories in a way for people who want to think a little bit more long term. And so that was basically the same. That was it. So over time, people that and people on my team and even newsletter writers, at Axios and Yahoo Finance and Business Insider, we often, in addition to covering the daily news, we also made sure to get that information out there, that historical context, talking to people like Ryan, who has like these great, every 30 seconds he's sharing context. And, of course, he's faced with tons of criticism, but he's just a messenger of this great historical data. And we would do things like that, share that information, share, what we've learned from history, and including times when things might have been worse, and frame the day's news in those contexts. And it turns out that there is a market for it. It's not the biggest market on the planet. You will not, one thing I know for sure from having worked at, Yahoo Finance that gets 100 million people every month, and Forbes that was once, the largest business news site on the planet, and Business Insider that, was, just dominating everything on search and social traffic. One thing I know with 100% certainty is that you cannot displace those players by telling that long-term story. But I do know that there is an opportunity. There is an opportunity. There continues to be an opportunity, and there can be 1,000 new newsletters and news sites that can start with this angle and this framing. They're just going to have to be able to operate much smaller. So yeah, that's the TLDR of how I broke free and I'm now doing this thing that I'm doing.
Well, Sam, maybe I could ask you kind of a natural follow-up question to that one. And we know that you're not a portfolio manager, you're not a financial advisor, but you do talk to the same audience that we do, and it's here mostly financial advisors. So this is kind of perfect. So Based on what you just said, this is kind of a two-parter. Part A might be, what's a simple framework? Because you use that word. Advisors like Jimmy here and others can use to keep clients fully invested during drawdowns like this. And we do it day in and day out, all the hand holding. I've designed entire programs around that question and providing answers. But I want to hear your response to that one. And part B there would be, how do you explain why and how the market just keeps going up over time to clients in a believable way?
Sure. Yeah. So I think there's about three things I wanted to hit with what you're saying. In terms of, so with my background, so when I was actually at Forbes back in ancient history during the pre-financial crisis period, if you can believe that, I was writing for two stock picking newsletters that was under the Forbes umbrella. And as part of the job requirement, my boss required me to be enrolled in the CFA program. And so I did that over 4 years, got my CFA charter, and met lots of people in the industry. And as I wrote more about what was happening in the world and the markets and all this stuff, I felt like I probably had somewhat of an advantage when it comes to things like, understanding how income statements and balance sheets and things like that work. And then, further down the road, how people might think of this in terms of their portfolios and things like that. As far as like a framework or a strategy or an approach to speaking to, whether it's other advisors who are looking for tips on how they can talk to their advisors, or if you're just straight up talking to the retail world. My approach, in particular with my newsletter, there's 1,000 different things that you can do, but one thing that I found to be somewhat effective is to prepare people during good times, right? And there will be good times at some point or another. I think we're all young enough that we will see a new all-time high at some point. And I think it's at those points you really have to hammer in the possibility that, hey, we could face another, 10, 14, 20% drawdown from where we are. Or, get those great, Detrick stats out there and say, by the way, don't be surprised if we have, 3-5% pullbacks within the next 12 months, and it's going to feel awful. So something that I try to really hammer is the possibility that what we're experiencing right now, like I try to get in front of that message as much as possible. But of course, you also want to back this with like the stats, and that's a thing. It's like I guess fundamentally, it all just comes down to the education, and the thing that helps the education stick is if you can get the timing right. Like in the throes of a crisis, nobody wants to hear about, average drawdowns and, average pullbacks and all that stuff because the house is on fire. Don't tell me about all this stuff. I think it could get worse from here. And it's so hard for people to focus when there's all this noise and, not to mention all these people on TV telling you why it's going to be worse and telling you why, this is the time that, sovereign debt levels will fire back at us. Or this is actually even scarier because now everyone's using AI to amplify all these negative messages and all this stuff. It's challenging in the throes of a downturn. But I think, and maybe it's maybe some advisors have missed the opportunity to get in front of it. But in the next cycle, I don't know if I would recommend people. I think people might be able to learn from this, but I've found that it's very effective to really get concerned or not concerned, but flag those things at the top. Because you get two benefits out of that. One, your clients, your readers, the traders, the subscribers, whoever, will themselves be better prepared when these things do happen. And then two, during the throes of a downturn, you can also remind them, hey, remember that conversation we had 6 months ago? Remember that conversation we had in January? I'm not crazy. There's a reason why, we have these conversations. There's a reason why you pay me to give you advice. And I can refer back to something I wrote, 6 or 9 months ago, that these things happen. So let's figure out if things are serious enough that we need to think about, tweaks to our strategy, or maybe we stick to the financial plan that we've already developed, and we understand that this is part of the volatility that we've been planning for.
That's a fantastic answer for that question, I think, and for us advisors to think about that more and put that into our practice. So when markets are setting new highs, sort of like this year, going into this year, most analysts were very bullish about this year. I know that we still are, actually. And we were last year too, but I mean, I think preparing investors for the for the downturns that are going to come. And we just don't know when, right? It's Sam, I always thought, or I've always been amazed that I would meet clients that have, north of 7 figures in investments, and they've been doing it for decades, some of them. And they actually can't tell you how much the stock market goes down every so often. Like, they just don't understand the gravity of how often, bear markets occur and how deep they are on average. For people that have millions of dollars and they have years of investing. So I think, again, that's probably a function of people have their heads down most of their lives, working their butts off, dollar cost averaging into their 401ks, right? It's usually probably the retirees that have had more experience with bear markets that maybe can remember those. Maybe that's why. But anyway, what a great message for us as advisors to put that into our practice, to manage expectations at the top. I've heard that from a business coach before as well. Both of you guys, I know, have an outlook today that's a little contrarian. So I'd love to hear you guys banter a little bit about that. Meaning, Talley's been on a rant lately, talking about how this crisis that we've got going on with oil, is not going to last. And and I know in reading some of your stuff most recently, you have a contrarian view as well. With the glass half full kind of attitude with that. Can you guys talk about that? Maybe Talley, you go first.
Well, sure. I mean, you know what I'm going to say, and this will resonate with you, Sam. I personally, as a practitioner and disciplined analyst, I love it when the bad news crescendos, because time and time again, this is where we really get to test our frameworks and our indicators, and it's chaos like this that creates the opportunities. And I remind folks, our listeners, that this is a gift, and you don't have to look that far back. It was almost exactly a year ago when the setup was very, very similar. And to my eye, the fundamentals in the U.S. really haven't changed. Earnings are at a record high, and the estimates keep getting revised up, and the margin tailwinds are intact, and retail sales are robust, and weekly economic activity indicators reaccelerating, and all this stuff it seems like it's getting ignored in the conversations and the narrative. So I'm a big fan of, well-timed, well-placed facts like that. And I think, this is where we start putting the cash to work and start nibbling. And Frank Capillari said, to your point, Sam, we had him on, I guess the past few weeks, but he caught our cautionary note on silver and gold. And we told everybody, hey, these runs up in metals have outstripped any kind of reasonable estimate of fair value at a time when it looks like things might be improving. And he said, fast forward, what was it, 2 months later, we should put that on all of our marketing literature, and now I think it's the opposite, right? The pendulum has swung in the other direction, especially for risk assets. So, I'll pause there because I could fill up the rest of the episode. But what are your thoughts here, Sam? Because I want to hear that.
And also I saw Sam post something in the last few days about earnings expectations, and analysts are actually guiding up, and he was giving reasons behind that. So that's very interesting, Sam. Go ahead.
Yeah, that's the hottest story right now. And if it's not on people's radars, this is something that people want to be paying attention to because it's so confusing.
It is.
But there's also some nuance there. And I think, first of all, I'll say that, I don't officially, I don't give views in terms of like targets and expectations. Like everything I try to put out there is the data as complete as possible, and I let the data do the talking. And it just happens to be the case that the data tends to slant bullishly. The market is usually up in an upswing 75% of history, and the economy is usually growing during 75% of the time, and most of the time things are pretty good. In particular when it comes to tangible things like measurable aspects of the economy, which are the things that actually drive returns and performance in everybody's portfolios. But yeah, that's exactly it. The data is coming back, and it's telling us that while we might think that there should be all these things that should be going wrong, while we think that, oh my gosh, the price of the gallon of gasoline has gone up $1 and now everyone's going to go bankrupt. I'm going to have to cancel, or people are going to have to cancel their vacations, or we're going to have to cancel, the kids' birthday parties and all these things. And, it's easy to think that in one's head, but in practice, that's just not the case. We had retail sales data recently that's actually comes on a lag, but there's more timely data that JP Morgan and Bank of America release on a weekly basis that shows their customers and their client spending activity. And something that we've noticed recently is that they both have measured this spike in spending at gas stations, which very much reflect, the fact that gasoline prices have gone up. So that's no surprise at all. But what's really interesting is that, debit and credit card spending for everything else that's not at the gas station has held remarkably steady. Mm-hmm. And so now, while at the margin, there are reasons to believe why there are headwinds developing for the consumer. But, if we really, zoom out and think really big picture as to, what drives consumer spending, it is stuff like, being employed, having a job, getting those regular paychecks, having some savings. There's been lots of stories, of course, of how savings levels have deteriorated a little bit and delinquency rates have gone up for households over the last 2 or 3 years. But again, this is something that needs to be taken in the context of household finances were unusually strong in late 2020 and 2021 because no one was able to go out and shop and no one was able to go out and take their vacations. But a lot of them were able to keep their jobs. Some were able to go back to higher salaries, and not to mention all this government stimulus that filled everybody's bank accounts. So that's that's history. But the point being that household finances, generally speaking, remain healthy, and that's reflected in the fact that consumer spending is still strong. And so that's just one element of many things that might seem counterintuitive, but it all feeds back into this much grander story of it is the case that not only are earnings expectations holding up, but it is actually the case that analysts are ratcheting up their expectations for earnings. And it's like there's all kinds of parallels to draw with recent history. In 2021, when inflation was going from 3% to 9%, everyone was freaking out that corporate profit margins were going to collapse and earnings were going to collapse, and it didn't happen. Because the world is more complicated than that, right? Because it turns out that corporations could charge a little bit more, and people had money, and so they paid up, and they were able to preserve margins and earnings growth and all that stuff. And it happened again in 2022 when people were freaked out that because the economy was slowing, and then even in 2023, you have high Fed funds rates and all this stuff. But yeah. It just all comes back to the data, right? Maybe sentiment might be driving some of the market story right now in the short term, but the bottom line is the bottom line. That's not to say that maybe in a couple of months it turns out there was too much optimism and that stuff gets revised out. Hey, that's just reality. There's no guarantees, of course, and everything. And I'm sure it's all in the disclaimers and the disclosures. Past performance is not guaranteed to happen, right? But actually, I just remembered the third question you had previously, and it was this general question of why do I think the market keeps going up?
Yeah.
over time. And I think it's actually very simple. It's actually probably incredibly complicated, but I think it makes sense to people who aren't even in finance. And it's this idea that people will always want things to be better or cheaper or faster. There's no one is satisfied with anything that they have. Even if you have like the largest television that's flat panel that's built into your wall, and you have every channel on the planet, and it's super affordable, and you're taking 3 vacations now instead of 1. But people will always figure out things that could be better. And as long as that sort of attitude exists for most people, there will be companies on the other side trying to figure this stuff out. Mm-hmm. There will be a motivation for some entrepreneur to figure out how to make a car with better gas mileage, or there will be someone who comes up with an even better movie watching experience, or there's going to be someone building another hotel that's nicer than everything that's out there, and that's even cheaper or even closer to your house. And the demand shifts in those directions, and those people become big companies, and then you get added to the S&P 500, and then 20 years from now there's a whole other story for why the market's going higher. But it's this endless demand from people who want more stuff, better stuff, cheaper stuff, and then there's going to be capitalism that incentivizes people to figure out how to provide those products, and some of them will end up in the stock market, which sends the stock market higher.
You got me. I just shelled out for a G5. I think it's like an 83 incher. So I did my part with the retail sales there. But I wanted to opine. Yeah.
Yeah.
I didn't mean to cut you off, but I wanted to opine on what you were saying about inflation and margins, because that's been one of my key charts serving up to advisors and their customers that, we have been seeing some inflation perk up here. But the point I've been making is there's a difference between good and bad in inflation. And we've actually been seeing the good kind at the producer level. And you can check this out yourself. But as long as the prices received by producers go up faster than the prices paid by consumers, that's your basic recipe for margin expansion. And it, hey, surprise, surprise, actually correlates very highly with the change in the profit margin. And so I think that's another simple, albeit macro way. I guess it's microeconomics because it's the study of the firm and profits and all that. But to explain why the estimates have been revised higher.
Yeah, I mean, speaking of micro, if we want to go even further micro, you just have to look at what the Delta CEO said 2 weeks ago. This is one of the companies and industries that's most exposed to things like higher energy prices and higher oil prices and jet fuel prices and stuff. And he comes out and he says, we have an incremental 8-figure bill because of the direction of crude oil prices. And so what else? What does he say? Well, he said, well, you know what? We're maintaining our earnings forecast for the year, the same earnings forecast we set out before the oil price spike. But we're saying that our revenues are going to be a little bit higher. So maybe that's a story where they might be feeling some pinch when it comes to profit margins. But it also sort of speaks to this greater idea that maybe they're going to be able to capture back some of those costs by raising airline ticket prices.
Yes,
because people who didn't buy that the G5 or whatever, they're still going on vacation and buying those plane tickets.
Yes. Well, so that's what I was going to say. So when you look at some of those high frequency data, and I was making this point just yesterday on our investment strategy committee call, that, lo and behold, we've seen quite a sharp rebound in airline traffic and hotel stays, and people are still traveling and spending money. And despite the rise in, gasoline and crude oil and jet fuel prices.
Yeah. And it's not even just, I think some of what the Delta CEO said was one of their biggest weeks in history happened after the war. And so this is after fuel prices are starting to get into those plane tickets. And this is after people are driving to the airport and seeing, the board at the gas station, go higher. So, there's like kind of a disconnect here between what you expect people to do versus what they're actually doing. But one thing I will say, and this is me, the realistic data person,
right,
and not the permabull speaking here, but I will say that it is. I would probably feel less comfortable about the resilience of profit margins right now in the context of cost deflation. I would probably feel less comfortable now than I did maybe 2 or 3 years ago, when households had a much bigger buffer of financial savings, and when their household debt levels were a little bit lower, and also on the corporate side too. It's funny, the corporate and the household side has mirrored each other similarly, everything from refinancing debt at low levels a couple of years ago. Still very strong balance sheets on the corporate side, lots of cash, low leverage, but not as robust as it was 2 or 3 years ago. So I know we've all been waiting for this profit margin collapse story for 4 or 5 years now, but just because it hasn't happened yet, and just because there is a strong case to be made that margins could go higher, doesn't mean that there is as much of a buffer now than there was a couple of years ago.
So it's interesting. Our CIO, Jim Warden, would normally be on this podcast as a host, but he's cruising around Italy right now. And so everybody's traveling still. And I've recently looked at some hotel prices and some airline ticket pricing for a trip possibly to Europe this summer or early summer. And man, they're expensive. I mean, these hotels, it's unbelievable what they can get. And I'm sure that from what I've understood about that is that mostly it's Americans that take up those boutique hotels and drive the room prices higher. So people still must have cash. And
you're also looking at different kinds of hotels than Sam and myself are looking at.
Yeah, we're on the lower leg of the K here.
Yeah,
I don't know about that. That's funny, but I'm not sure about that. But the other thing is, anecdotally, I saw in your post about retail sales, Sam, department store sales were up 2% or something like that. And so it was a big part of the number that was reported for the last month. And just anecdotally, I'm in San Diego right now. I came to visit my mom and my family and also for a business meeting. And I was had lunch at the outdoor mall here. And I know it's spring break here, but man, it was busy. On a Monday afternoon, it was slamming. And so just phenomenal how resilient the consumer has been. I am curious though, what are some of the interesting charts and data points that you're seeing now that would, point you in the direction of what you're thinking right now? Is there anything around private credit that you've seen data-wise that's concerning around that? Obviously once we get past this oil, we've got other issues to think about, and that's one of them. But is there anything interesting that you're seeing today?
Yeah. So, it's something that I've been doing my best to try to wrap around what the real story is. And, it seems to shift depending on who you speak with or who's providing the research or who their clients and their audiences might be. So I think there's two things that I've picked up in terms of the patterns I've been seeing in the research I've been consuming and the folks who I've been talking to is one, from a financial institution systemic risk macro perspective, there's an attitude or an assessment that this is not a systemic issue, but it is the kind of thing where every couple of months you're going to hear about some concern in the financial system, maybe, this is sort of apples and oranges, but it wasn't 2.5 or 3 years ago we were talking about regional banks being in trouble and Silicon Valley Bank and some of these other things, and like, oh my gosh, like this is the thing. So on one hand, at a high level, and these are, by the way, this famous last words, right? But at a high level, there's this the analysis seems to suggest that yes, there are issues in some funds, and it's not even necessarily even the quality of the credits, but just the nature of the people who want to pull their money up. Maybe there are some issues there, but not a systemic concern. Taking it down another level that that I'm trying to understand is, well, who does this actually affect, and how does that spill into the economy? Whether it's second order effects of the financial institutions, or maybe something a little bit more direct in terms of people who might be exposed to this. And it's not a small market. I don't know what the numbers are. It might be 2, 3, or $500 trillion, which is maybe under 10% of the private equity market. However you measure it. Anyways, all that stuff is mumbo jumbo, and admittedly, I'm no expert there. But every time I've been presented with that information, there is this sort of restriction that basically, if anyone's going to be affected by that on the consumer side, it's going to be people on sort of the high end of the K, right? You can't get exposure to this stuff unless you're putting in, 5 figures, whether it's 10 or 20 or $30,000 to step in. And I've talked to people offline. This is actually another funny thing, and you guys deal with wealth management clients, and I'm sure there's some funny stories when it comes to this stuff too. But I get 2 kinds of stories. There are the ones who people have been approached with these great private credit opportunities, but they don't feel right about it. And some of them have a little bit of financial savvy, and they're like, this feels like the new hot thing, like SPACs a couple of years ago, and I'm not sure I feel good about my traditional portfolio. So there are folks who were resistant to that, and then there of course are the folks who put a decent chunk of their portfolio into some of these asset classes, and but they don't want to tell anybody about it.
Yeah.
And they're not going to cancel their vacation, and they're not going to cancel their the birthday party for their kid. Like, yeah, it might affect it hurts to see the value of some of this stuff be questionable when it's on your balance sheet. But again, if you're on the higher leg of the K, you probably have other financial resources that you can tap into, so that your neighbors don't realize that you might be hurting in the short term. and I don't mean that as a joke, but sometimes we all operate in the real world. It ties back to what we were talking about before, where it's like, how can we talk to people while they're scared, even though they're experienced investors? This is the same brain working, the same brain that makes us make bad decisions during periods of market volatility, has to protect the pride of the family. And but that's a psychological thing. And maybe those are things that need to be talked about to clients. But from a markets perspective and an economic perspective, the data is coming back telling me even the higher leg of the K in this K-shaped economy is still also spending. So yeah, that's sort of the 2 ways I think of this story, which again, admittedly, is over my head a little bit. But the indications seem to be that it is of high interest to those who are directly exposed. And if you're thinking about the market and the economy broadly, maybe this is not a thing to be losing sleep over.
That's kind of how I feel about it too. I don't. Obviously, we get solicited as an RIA from all the different vendors out there that do private credit. Fortunately, the way that we access private markets, there's a very good, extensive, and difficult to get through due diligence army of people. So, but I use private credit, but I almost feel like that advisors with some of these products that have some liquidity are the reason, meaning that the advisors are freaking out, and it's not necessarily their clients calling them up and saying, get me out of private credit. I've heard about it in the news, but advisors want to get out because they've made money on it. So maybe we're part of the problem too. I don't know. Is there anything else that you're seeing in the data that you look at, the charts that you're producing that point you in a certain way or another right now?
I think the most fascinating thing that's been developing in the economy is this sort of disconnect between what has been a stable unemployment rate and a stable layoff rate, and job creation has cooled a bit, but it's sort of flat. That being on one end of the labor market equation, and then the other side of it being the turnover has sort of tanked, right? The rate at which companies are hiring has fallen very sharply, and you got to go back years before the pandemic to get to the hiring rates that we're seeing right now. And similarly, quits rates have also tanked, and so that's two things, right? One, a company might lose people through retirement or attrition or whatever, run-of-the-mill people leaving, but they're not rushing to fill positions. And then two, that's also sort of complemented. I mean, these are both sort of opposite ends of the same coin. People don't seem to be as willing to step away from a job and take a new risk. Maybe it's because there isn't actually an opportunity on the other side, or maybe they are concerned about their own job security. But here's where it gets interesting. There is this idea out there. I think there's different phrases that I've seen used for this, but this concept of a quote unquote tenure dividend, where if a large chunk of your workforce are new employees that have started in 3 or 6 months, they are still in the training period to get used to the software tools and figuring out how management works and finding where the bathroom is and how to make a tech request with IT at the company. They are not fully operational yet, and so they are not productive assets in your company. And similarly, on the quits side, if you have high performers constantly getting poached by other companies, then you lose, some productivity there too. So the sort of upside, and I'm not speaking from like a humanitarian perspective. I'm speaking strictly from a stock market earnings perspective. The plus side of all this is because of the low turnover, because you're not spending a lot of time, you don't have a whole lot of employees in training, and because you're also not losing a whole lot of experienced employees, you're able to benefit at the margin, but it's not nothing, from productivity gains that you would have lost if the labor market had more turnover in it. So I think that's an interesting thing. I don't know if it's completely a massive game changer, and eventually it gets to the point where if labor market dynamism completely falls apart, there's other bigger issues. But in the near term, at least, there seems to be some upside to labor market dynamism, slowing down if people can wrap their heads around that.
Fascinating. What do you think, Talley?
Well, I wanted to ask you kind of a different question, maybe a broader one from one storyteller to another. And I know we both went to Boston University, but we similarly followed a non-traditional path, shall we say, to Wall Street. And in my case, it was classical music performance. That was my undergrad. But you studied religion. And if memory serves, when I was there, I think Martin Luther King Jr. studied religion there too. Pretty famous halls to be walking around in. But I wanted to ask you, given you're kind of like me, very colorful and rich and diverse background and experience. You talk about all the places that you've you've worked Axios, Yahoo Finance, Forbes, Business Insider. I think you're involved with Fred now too. I love Fred. I use it all the time in my research. You got your CFA, but my question to you is, how has your thinking about and writing about markets changed just over the arc of that experience, and just kind of, give us the full circle picture?
Yeah. So let's go way back into history. So I grew up in Louisville, Kentucky, and my father is a Southern Baptist minister. And
Wow.
so I grew up, watching him speak in front of anywhere from 100 to 150 people every Sunday, and interacting with all these people throughout the week and those days too. And I think I think in the moment I kind of took for granted what I was experiencing. I mean, that's the nature of being a kid, right? Whatever is happening around you, you feel like that's just what everyone's experience is. But it wasn't until I was much older I would get weird questions from people about how I speak or whatever. And the more I thought about it, the more I realized I've picked up a lot of things from the way my father spoke when he spoke in front of other people. So I think that maybe has something to do with why I am in a trade where I am speaking to people and I have to communicate something to people. That's one thing. Something more recently in terms of my approach to writing and also the approach to the newsletter. And Jimmy, you're mentioning how a lot of basically everything I write about goes back to this sort of 10-point framework that I set out. And if people are curious about that, I'm happy to share links and all that stuff. But yeah, basically everything I've been writing about for the past 5 years goes back to, these 10 big long-term themes that sort of help me understand how the stock market works. And when I was in the news business, there was always this sort of challenge and friction and pushback from the higher ups when you repeat things, right? Because almost by definition, well, how's that news? How many times can you tell me that there's going to be a 14% drawdown on average every year? You've written that post 15 times now, and I never could articulate why that approach to writing mattered. I mean, maybe listen, the news business is different, right? It's in their name. It has to be new, and that's what people are showing up to. That's why they subscribe to newsletters and they turn to the different news channels. But for me, and this gets back to my upbringing, and I sort of had this eureka moment about a year ago, that what, I grew up in a church where every week there are lessons being taught on repeat that come from a book that was written 2,000 years ago. And so how many, and this isn't just like a church thing or a Christian thing, but like every different religious practice or every different community or anybody that has any kind of historical root has stories that get retold over and over and over. You meet with your college buddies or your high school buddies or your drinking buddies, and how often do you tell the same story over and over and over again? And there's some magic to this, but especially in the context of education and things like religion or whatever. And I don't want to keep visiting that too much because it gets, I don't want it to become too sacrilegious, if you will. But I found that it is possible to retell, and there's a demand for this, to retell the same set of lessons, month in and month out, quarter in, quarter out, while pegging that to the news. I mean, this is something that you do hear when a religious practitioner speaks on the nature of things. Like, here's what's happening today, but in Matthew chapter something, there's this lesson that we can apply to here, and this is how we become better people. Here's something that's happening in the news today, and it's doing all these things. I can track this back to one of these things in the framework, and I'm going to share that message with you again. Maybe you know, but maybe you needed a reminder, or maybe you didn't need a reminder, but sometimes you just need to hear it out loud from someone else so that you're not going crazy. So I think that kind of, and listen, I need to probably spend some time with a therapist or something to really unpack all this. But my understanding of how I've gotten to where I am, I think stems from responding to people who have told me that they like the way I communicate to them. And then two, seeing that it is possible to repeat certain messages and certain theses, but connecting it to something that's happening today.
That's great. Maybe we can kind of get closer to the end here as we're coming up on the hour, talking about some of those 10 things. I'm not going to ask you to repeat all of them, but what are some of those tenets that you believe in, that you anchor against?
And before we do, I don't know about you, Jimmy, but I like Sam more and more. We talk to him. I think I'm going to call you our market minister and prophet pastor. That's a good tag for the episode.
I might have to change the name of my newsletter.
There you go.
But yeah, so I think there's one timely principle and one sort of under the radar principle. One, that the sort of most destabilizing risks to the markets are the ones people aren't talking about. And in my list of those 10 sort of concepts, that actually follows one that states there's always something to be uncertain about. And there's sort of a nuance here. I'll just briefly hit on what this means. First of all, this idea that there's always uncertainty. You ask anybody, they will always be able to generate for you a top 5, top 10, top 20 list of things that they are worried about as an investor or as a fund manager or as someone who's exposed to the financial markets. And you survey 1,000 people and half of them will basically be able to repeat for you that same exact list. This actually defines the premium or the discount we get as investors in the stock market, right? This uncertainty is the reason why you end up getting a higher return over time, because if you didn't have anything to worry about, then why would you be rewarded for taking any kind of risk in the financial market? So that's one thing. There's always going to be things that you can identify that you can worry about, that everyone's going to worry about. Now, this other thing, the risks that people aren't talking about, the ones that do become more destabilizing, the ones where if you were to survey a bunch of people, that very few, if not no one, would be able to put on their list of top risks. When those things materialize, that's the stuff that tends to rock markets the most. An obvious example of this is, of course, COVID and the pandemic. And, there's a lot of nuance to that whole thing, but I guarantee you there were very few people saying global pandemic is my top financial risk, in January of 2020. But of course, in March and April, it shoots to the top of everybody's list. So now this is something that's being priced in the markets. But yeah, this is the point, right? It's just the new presence of a new form of uncertainty is enough to bring markets down because of just because we don't exactly know how to price this, and two, it wasn't priced in at all. So kind of like, another example of this would be Silicon Valley Bank, for instance. No one was talking about regional bank failures as something that could destabilize markets, but when it emerges, no one is quite sure to what degree this will have an effect on markets. So even if it's not material, just the uncertainty alone is enough to bring prices down. And I can talk about this for another hour, but I think this sort of speaks to why we're dealing with volatility right now. In one of the 1,000 surveys that some of us follow, the Bank of America Fund Manager Survey, this is conducted every month with 400 or 500 of the fund managers who use Bank of America for their services. In February of this year, geopolitical turmoil, geopolitical risk or uncertainty, I believe it was 4 or 5 on that list, which means if you're not in the top 1 or 2 or 3, it's considered basically an immaterial risk. Now, as of March, it's number 1. So, again, there's going to be things that will come out of nowhere. And by the way, that in itself is unprecedented, but those are the things that tend to rock markets much more than the risks that are right in your face. That's one thing. 2, and this flies under the radar a little bit, is that the stock market has a lot of turnover. This is a concept that I try to write about as much as possible. But, when you are, for instance, if you are heavily allocated towards something like an S&P 500 index fund or any sort of stock market index fund, there's a lot of turnover in these indexes. I think the last measure I saw is that on average, 5% of the S&P 500 turns over every year. And on a rolling tenure basis, about, a third turns over. So there's not a static set of stocks, but it gets back to something we were speaking to earlier, which is if you stick to 500 companies and stick to them forever, you're probably going to do pretty poorly because a lot of them will lag and fail and fall behind as other companies emerge. What's so intriguing about things like the S&P 500 and the stock market in general is, 10, 15, 20 years down the road when we eventually retire, there's going to be a slew of new companies that we've never heard of, that we've never imagined, in industries that might not exist yet, that'll be driving returns and performance in the stock market. It's going to happen. It's happened in the last couple of decades. Facebook, Google, all these companies are, were conceived after we even came into this industry. And then, before that, there are all these companies that were driving the markets that don't exist anymore. So that's something that's very important, is this dynamism in the stock market. But all that, again, getting back to what we were talking about earlier, all that being propelled by this dynamic of there will always be people who want things that are new, better, faster, cheaper, and the capitalist system incentivizes these people to figure out those new things and those cheaper things and those faster things. And that's something to be optimistic about.
That's awesome.
That's great. In economics, of course, we talk about the only constant being change. And recently we've referred to that as creative destruction or Schumpeterian growth. And so it might feel bad now in the moment, to your point, Sam, but just a little bit of creativity, I think, goes a long way. And we can start to envision and extrapolate. It might feel like science fiction, but it's really not. All the different ways that this market and economy can evolve and change, and the industries and jobs that will be created that we just haven't imagined yet. So I think that is a very optimistic and positive way to kind of end the episode. And Sam, this has been a real pleasure. I'm sure we're going to have you on again.
Yeah, this was fun. That time went very quickly. We'll have to do it again.
I can't wait to see you in Manhattan and buy you some Korean barbecue and serve you some soju. So looking forward to that. And I would say that you guys just reminded me of one of my favorite quotes from another financial advisor coach, Nick Murray. And he says that human ingenuity, well, besides love, human ingenuity is the most powerful force on earth. And the way to capture that is through common equities, common stock. And so you guys are kind of saying the same thing, right? So great to have you on. Nice to meet you finally. And I look forward to meeting you in person. Thanks for joining us.
Thanks for having me.
Come and dance on our floor.